Hello, and welcome to our video on how corporate risk management affects the financial market and its products. Corporate risk management is the process of identifying, assessing, and managing the risks faced by a business. It's an essential part of any organization's strategy, as it helps mitigate potential losses and ensures business continuity. Now, let's take a closer look at how corporate risk management affects the financial market and its products. Firstly, risk management strategies employed by corporations can affect the financial market by influencing the supply and demand of financial products. Risk management strategies employed by corporations can influence the supply and demand of financial products. For example, when a company decides to hedge its foreign currency exposure, it will buy or sell currency derivatives to protect against currency fluctuations. This buying or selling activity can affect the supply and demand of currency derivatives in the market, leading to changes in their prices. Similarly, when companies decide to engage in other risk management strategies, such as interest rate swaps or commodity futures contracts, they can affect the supply and demand of those financial products. This can, in turn, impact the prices of those products and the overall market. It's important to note that these effects are not always straightforward or immediate. The impact of corporate risk management strategies on financial products and markets can be influenced by a variety of factors, including the size of the company, the type of risk being managed, and the overall market conditions. Additionally, the impact of corporate risk management strategies can vary depending on the perspective of different market participants, such as investors, traders, or regulators. Overall, the influence of corporate risk management strategies on the financial market can be complex and multifaceted. However, it's clear that effective risk management is essential for companies to ensure their financial stability and sustainability, and it can play a significant role in shaping the financial market and its products. Secondly, risk management can also affect the financial market by impacting the creditworthiness of companies. Effective risk management practices can improve the creditworthiness of companies, while weak risk management practices can lead to a lower credit rating. Credit rating agencies assess the creditworthiness of companies based on their ability to manage risks effectively. A company with a higher credit rating is seen as a lower credit risk, making it easier and cheaper for them to raise funds in the financial market. This is because investors are more willing to lend money to companies with a high credit rating, as they believe they are more likely to repay their debts. On the other hand, a company with a lower credit rating is seen as a higher credit risk, making it more difficult and expensive for them to raise funds in the financial market. This is because investors will demand a higher return on their investment to compensate for the increased risk of default. Effective risk management practices can improve a company's credit rating by reducing the likelihood and impact of negative events, such as financial losses or business interruptions. This, in turn, can increase investor confidence in the company and its ability to meet its financial obligations. Effective risk management practices can improve a company's creditworthiness, making it easier and cheaper for them to raise funds in the financial market. On the other hand, weak risk management practices can lead to a lower credit rating, making it more difficult and expensive for them to raise funds. Thirdly, risk management can also affect the financial market by influencing the behavior of investors. Risk management practices employed by corporations can have a significant impact on the behavior of investors. When companies are transparent about their risk management strategies and their exposure to different types of risks, investors can make more informed decisions about investing in them. For example, if a company is transparent about its risk management practices and demonstrates a strong ability to manage its risks effectively, it may attract more investors who are willing to invest in the company's products or services. These investors may view the company as a lower risk investment and be more likely to invest in its shares, bonds, or other financial products. This increased demand can lead to an increase in the price of the company's financial products and ultimately benefit the company's shareholders. On the other hand, if a company is opaque about its risk management practices or demonstrates a weak ability to manage its risks, it may deter investors from investing in its financial products. This decreased demand can lead to a decrease in the price of the company's financial products, making it more difficult and expensive for the company to raise funds. Moreover, the behavior of investors can also affect the overall risk of the financial system. If investors perceive a particular company or industry to be risky, they may sell off their shares or other financial products, leading to a decrease in the price of those products. This can trigger a broader market sell-off, leading to a systemic risk. Conversely, if investors perceive a particular company or industry to be less risky, they may buy more shares or other financial products, leading to an increase in the price of those products and a reduction in systemic risk. Risk management practices employed by corporations can have a significant impact on the behavior of investors and the overall risk of the financial system. By managing their risks effectively and being transparent about their risk management practices, companies can attract more investors and reduce the overall risk of the financial system. Lastly, risk management can affect the financial market by shaping the regulatory environment. Effective risk management practices can influence the regulatory environment by shaping the perception of risk and the need for regulatory oversight. For example, if a company engages in risky activities that have the potential to create systemic risk or cause harm to consumers, it could attract the attention of regulators. This, in turn, could lead to the implementation of stricter regulations on the industry, aimed at mitigating the risk and protecting consumers. On the other hand, if companies demonstrate effective risk management practices, they may be seen as less risky and less likely to cause harm to the financial system or consumers. This could lead to a more favorable regulatory environment, with regulators being more lenient towards such companies and their activities. In addition, the effectiveness of risk management practices can influence the perception of risk in the financial system, which can also impact the regulatory environment. If companies are seen as effectively managing risks, it can help to reduce the overall level of risk in the financial system and increase confidence in the market. This, in turn, can lead to less stringent regulations and a more relaxed regulatory environment. Overall, the relationship between risk management and the regulatory environment is complex and interdependent. Effective risk management practices can help to shape the regulatory environment by influencing the perception of risk and the need for regulatory oversight, while the regulatory environment can also impact risk management practices by setting standards and enforcing rules. In conclusion, corporate risk management plays a critical role in shaping the financial market and its products. By managing their risks effectively, companies can influence the supply and demand of financial products, impact their creditworthiness, influence the behavior of investors, and shape the regulatory environment. Thank you for watching, and we hope you found this video informative.